Welcome to Iron Financial, the show that forges stronger portfolios by cutting through market weakness. I'm your lead analyst. Datadog just reported earnings, and the stock ripped 8.7% higher in a single session. The market is absolutely euphoric. And I'm your market skeptic. My job is to ask the question that everyone should be asking behind that pop. Is this rally built on a bedrock foundation of fundamental strength? Or are we looking at a beautiful, hollow facade that's designed to trap investors right at the very top? Today, we are not just going to read you the press release. We are putting Datadog's Q4 report under a microscope, and then we're taking a sledgehammer to it. We are going to stress test the entire structure, from the financial bedrock all the way to the forward-looking blueprints, to see if this thing can truly withstand pressure. This is the deep dive you've been waiting for. So here's the blueprint for today's analysis. First, we are going to dissect the headline numbers that lit the fuse on this big rally. Then, I'm going to build the bull case for you brick by powerful brick to show you the immense structural integrity of this business. And when he's done building his perfect little fortress, I'm coming in to look for the flaws. I am going to pressure test that entire structure, looking for every single hairline crack in the foundation, every weak joint, every sign that the architect's plans for the future might be fundamentally flawed. Finally, we'll weigh all the evidence, the bull versus the bear, and deliver the iron financial verdict. Is this a generational opportunity, or is it a dangerous trap? All right, let's get into this. First things first, let's look at the catalyst. An 8.7% jump in a single day for a company of this size? Well, that isn't just market noise. It is a massive signal. The market saw something in this report that it absolutely loved, and you better believe institutions started buying with both hands. So what exactly did they see that sparked such immediate, aggressive optimism? And here it is, a clean sweep across the board. This is the trifecta that gets Wall Street to sit up straight and take notice. Datadog didn't just squeak by, they delivered decisive, powerful beats across the board. Look at that revenue number, $953 million. They crushed estimates by $35 million. That's not a small miss by the analysts. That's a huge sign of incredibly powerful demand. Then you look at the adjusted earnings per share, the bottom line metric that everyone watches. They beat by over 6%. This tells you they aren't just selling more, they're doing it profitably. And crucially, adjusted operating income also surpassed estimates, which speaks directly to the efficiency and the scalability of their core business model. You have to understand, in a market that is hungry for good news, this wasn't just a good quarter. It was a statement quarter. It screamed momentum. All right, now let's build the real bull case. Because that headline beat you just saw, that's just the entryway to the fortress. To understand the true strength here, you can't just look at the surface. We need to go deeper and inspect the underlying structure. We're going to analyze the load-bearing numbers, the deep metrics that tell you whether a company is built for a quarter or if it's built for a decade. This is where the real story is, and it's a good one. Let's start right in the engine room. Year-over-year revenue growth of 29.2%. Now, I want you to let that sink in for a second. This is not some small-cap startup finding its legs. This is a nearly $40 billion market cap company, and it's generating close to $1 billion in revenue every 3 months. To be growing your top line at nearly 30% at that kind of scale is nothing short of phenomenal. In an environment where companies are scrutinizing every single dollar of IT spending, Datadog is still expanding its territory at a pace that leaves most of its competitors in the dust. This is the unmistakable sign of a market leader taking share. Okay, next up, let's look at how this momentum is building through the quarterly billings. Now, this is one of the most important non-GAAP metrics for any software as a service company. I want you to think of it as cash revenue. It's the total value of all the invoices they billed to their customers in the quarter, and it's a critical forward-looking indicator of demand. At $1.21 billion, billings grew a massive 33.5% year over year. You see that? That is significantly faster than the revenue growth. This number is screaming at you that customers are not just renewing, they are signing bigger, longer-term contracts, effectively pulling future revenue forward. It signals accelerating demand for their platform. It's a huge vote of confidence. And right here, this is the financial bedrock of the entire fortress, a free cash flow margin of 30.5%. This is a measure of pure, unadulterated financial strength. For every single dollar of revenue Datadog brings in the door, over 30 cents is converted directly into cash after all the operational and capital expenses are paid. This is not some accounting profit. This is cold, hard cash hitting their bank account. At this level, Datadog isn't just a growth story. It's a cash-generating machine. This gives them a war chest. It provides immense flexibility to innovate, to acquire other companies, to invest aggressively in sales, or to weather any economic storm without even breaking a sweat. And this chart, this brilliantly illustrates the real foundation of the entire business. See, it's not just about getting more customers. It's about getting the right customers and then growing with them. This is the land and expand model executed to absolute perfection. Look at this enterprise adoption. The number of customers paying them over $100,000 a year is up a very strong 19%. But the real story, the one that matters most, is in the whale accounts. The number of customers spending over $1 million a year with Datadog grew by a staggering 31% year over year. These aren't startups, These are the largest, most stable enterprises in the world, and they are embedding Datadog deeper and deeper into their mission-critical operations. That creates incredibly high switching costs and builds a powerful, powerful competitive moat. This is the bedrock of a durable, high-margin enterprise software company. And to cap off this bull case, management themselves are projecting continued strength. Their own forecast for next quarter's revenue came in nicely above what Wall Street was expecting. They are signaling confidence in their near-term pipeline and in their ability to keep executing. So, let's put it all together. The crucial point is this. The bull case is built like a fortress. You have powerful revenue growth as the outer walls, incredible cash generation as the treasury inside, and a rapidly expanding base of high-value, sticky enterprise customers as the unshakable foundation. That is a very solid, very impressive-looking fortress. I will give you that. The materials look top grade, that customer foundation is solid, and the cash treasury is definitely full. But even the strongest walls can hide weaknesses. And from where I'm standing, the blueprints for the future don't look nearly as flawless as the structure you just built. So I think it's about time we apply some real pressure and see what starts to buckle. Any company can put up one good quarter. That 8.7% stock pop was a reaction to a single data point. We at Iron Financial, we're interested in durability, in long-term structural integrity. So let's just ignore the fresh coat of paint from this Q4 report for a minute, and let's stress test the long-term trend of that growth engine you were just celebrating. Is it truly built for the long haul, or is it already past its prime? Now, what's really interesting about this slide is the deceleration it reveals. That 29% growth in Q4 looks great in a vacuum. I get it. But when you zoom out, a much more troubling picture starts to emerge. The 5-year compounded annual growth rate was a blistering 41.5%. But over the last 2 years, that has cooled off significantly to 26.9%. Now, while that's still a healthy number, the trend is undeniable, and it is pointing down. The engine is losing steam. This is the first hairline crack in the facade, a clear mathematical sign that the hyper-growth phase is moderating, and the law of large numbers is finally taking hold. But this right here is the main event. This isn't just a hairline crack. This is a potential structural flaw. We call it the guidance paradox. On one hand, management signals short-term confidence by raising their revenue guidance for Q1. Okay, that's the good news that the market reacted to. But in the very same report, for the full upcoming year, they guided profitability down, and not by a little bit. Their forecast for full-year adjusted earnings per share came in a shocking 9.5% below what Wall Street was modeling. The market may love revenue today, but it prices stocks based on the discounted value of all future earnings. This is a major, major red flag being waved by the architects themselves. And let's be crystal clear about this. This isn't some distant, full-year problem they have time to fix. They are also guiding down on earnings for the very next quarter. They expect to earn about 50 cents per share, while the consensus on the street was looking for 54 cents. So you have this situation where the front of the building looks freshly painted with a strong Q4 and a good Q1 revenue guide, but the financial plumbing for the rest of the year is showing signs of some serious corrosion. Management is telling the market in no uncertain terms to expect lower profitability for the entire year ahead. That is a warning you ignore at your own peril. Okay, those are fair points. A significant crack in the full-year guidance is a legitimate concern, and it's something we absolutely have to examine. But you're completely ignoring the critical context of how they calculate those earnings. You're treating it like it's a fatal flaw without understanding the materials being used. You can't just look at the number on the blueprint. You have to understand why it's there. It is absolutely critical for everyone to understand that we are talking about non-GAAP EPS. As this slide shows, these adjusted figures exclude certain expenses. And the big one here, the one that really matters, is stock-based compensation. To attract and retain the best engineers and salespeople in the world, especially in the hyper-competitive fields of AI and cloud, you have to pay them with equity. Datadog is making a strategic choice to invest heavily in its people to fuel future innovation. That is not a flaw. That's a long-term investment in the company's human capital. It's reinforcing the foundation for future growth. You call it an investment, I call it a real cost that dilutes existing shareholders. Every single share granted to an employee reduces the ownership stake of the investors. Ignoring it on an adjusted P&L doesn't make that cost just disappear. But more importantly, your argument misses the entire point.
The guidance miss is a signal that even after you make those adjustments, even after you add back those massive stock-based compensation costs, future profits are still not going to meet expectations. The math simply isn't adding up to what the street thought it would be. It's a fundamental miss.
So it all comes down to this fundamental conflict. On one side, you have a powerful, cash-rich company with an undeniably strong operational engine, and it is executing at an elite level. Its roster of the world's top-tier clients is not just growing, but spending more and more every single year. The fortress is real, and it is battle-tested. And on the other side, you have a company showing clear mathematical signs of slowing top-line growth, which has just explicitly told the entire market to lower its profitability expectations for the next 12 months. The cracks are visible to anyone who is willing to look closely at the blueprints instead of just standing back and admiring the finished building. Okay, it is time for the final analysis. We have inspected the foundation from every possible angle. We've stress-tested the frame. We have examined the blueprints for the future. So what is the Iron Financial verdict? After that big 8.7% rally, is this an opportunity to build wealth, or is it a trap waiting to spring on unsuspecting bulls? The heavy lifting in this quarter's report and in the stock's reaction that followed was done entirely by the backward-looking numbers. The revenue beat, the massive billings, the incredible customer additions. They were all stellar. This tells us that the core business, the companies it exists right now, is exceptionally healthy and executing at the highest level possible. But investing is always a game of looking forward, not backward. The forward-looking guidance is the architect's plan for the next phase of construction, and that plan has a clear and significant weakness right on the profitability line. That 8.7% stock pop feels like a knee-jerk emotional reaction to a great history lesson, not a sober and rational assessment of the future challenges that management themselves just clearly outlined for everyone. So the crucial point from my perspective is this: the foundation is fundamentally solid. You just cannot argue with 30% free cash flow margins and 31% growth in million-dollar customers. Those are legitimate steel-reinforced pillars of strength. They can support the overall structure through significant turbulence. This company is built to withstand pressure. But the official forecast is for turbulence. You can't just wish it away. The guidance miss isn't some bearish analyst's opinion on the street. It is a direct warning from the architects themselves, the management team, that the next phase of construction will be more difficult and less profitable than they previously thought. Ignoring that warning is a critical mistake for any investor to make. So no, we don't see this as a crumbling facade. That metaphor just doesn't fit here. The underlying business is far too strong, the cash generation is too immense, and the customer base is too sticky and too loyal for that. The core structure is absolutely sound. But we don't see it as a screaming buy at this new higher price either. The market has enthusiastically priced in all of the good news from Q4, but it may be seriously underestimating the forward-looking risk that was so clearly signaled by that weak earnings guidance. So to answer our initial question, it's not a trap, but the prime opportunity may have already been in that immediate post-earnings pop. From these levels, caution is warranted. The easy money has been made. And that right there is the billion-dollar question that we'll be watching for the rest of the year. Will the undeniable strength of their enterprise customer adoption, that 31% growth in million-dollar accounts, ultimately power through and allow them to outperform their own cautious profitability forecast? That metric is the ultimate leading indicator. It will determine the next major move for the stock, and it's what you should be watching. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.